Equity markets were strong during the June quarter, with global equities up nearly 6% for the quarter on an unhedged basis. Listed infrastructure securities outperformed during this period, with the FTSE Infrastructure Index up 6.6%. This strong sector performance followed an extended period of underperformance relative to global equities. Last quarter report, we expressed our view that the sector had become relatively attractively valued. So it's pleasing to see an initial, albeit modest, outperformance occur. Our fund was up 5% and so underperformed the sector. Pleasingly, we saw a strong bounce back in the pipeline sector that had detracted from performance in prior quarters. 3 of our largest 5 relative contributors were North American pipelines, and 2 of these entities had corporate activity announced during the quarter. We continue to see valuations in this sector as being very attractive. The main detractor was weakness in regulated assets in Brazil, Australia and Canada. The broader Brazilian market was weak on macro concerns, whilst in Australia and Canada there was some regulatory and political noise around the regulated assets that we own. A key reason for discussing this stock has been to illustrate our approach when an investment thesis does not unfold as we expected. In this case, primarily due to devastating fires within its service territory in 2017. We responded to materially adverse news in this instance by intensifying our research focus even further, so to ensure that we continue to have the best available information to base our investment decisions around. We've recently set out a number of these actions in a detailed note, which we'd be very pleased to share with our interested clients and their advisors. The second reason that we've wanted to discuss this company is as it is currently waiting to receive the outcome of the investigative report for the largest of these fires, the Tubbs fire. And so it's quite possible that Pacific Gas and Electric could be a large positive or negative detractor in the September quarter. We've considered carefully the level of risk that we're willing for the portfolio to assume in such circumstances, weighing the strength of our conviction in this investment with the inherent uncertainty that exists, and so the large range of potential return outcomes that could eventuate. I think it's important to note that even with the detailed research that we've applied over the last 9 months, there remains a probability that we are wrong. Indeed, the fire investigations that are ongoing by the state are highly confidential, and so if we had knowledge of their results, which of course we do not, then we would be operating with inside information. We hope that by setting out our thesis in the note, it may be useful for our investors to understand why we believe the risk to be one that is well worth assuming, notwithstanding the inherent uncertainty. We continue to find attractive opportunities in North American pipelines, as touched on earlier, and in European transportation infrastructure assets, including airports, toll roads, and a railway concession. We also very much like UK regulated assets, and in particular, the water businesses. The sector's current 5-year regulatory reset will be finalised in 2019. Whilst this creates some uncertainty, in our opinion, regulation in this sector has been fair and predictable over a number of regulatory cycles, and we expect it to continue to be so. There has also been some concern in the market about the risk of nationalisation were Jeremy Corbyn to win the next election, although we see this risk as having been overplayed and have taken the opportunity to build up a meaningful position at what we see as very attractive levels. We continue to invest the fund in core infrastructure assets that possess high barriers to entry and strong strategic positions, today holding a concentrated portfolio of 30 high-quality names across 14 countries. The largest individual country exposure continues to be the United States at 32%, followed by the UK at 13% and Canada at 12%. Overall, we remain positive on the long-term outlook for the infrastructure sector as an investment. Most importantly, this is based on our view of current valuations in the sector, but also more broadly considering the ongoing increase in demand for long-dated, stable income streams by various investor types, and the growing need for further private sector infrastructure investment. Thank you once again for your ongoing interest and support of our fund.